Hello everyone, I'm Rajashree Murkute, Senior Director at CareEdge Ratings. As we celebrate the company's 30th anniversary, we've released a special report on how infrastructure will be the key drive of growth during the Amrit Kaal. The report was unveiled by Shri Nitin Gadkari, Honorable Minister for Road Transport and Highways, Government of India, at the CareEdge Conversations event on May 23, 2023. Today, I'm here to share CareEdge's views on India's infrastructure financing landscape. India's G20 presidency presents an opportunity for the country to shape its infrastructure agenda and lead the way in global infrastructure development. With the aim of achieving a $5 trillion economy by 2025, India recognizes the crucial role of infrastructure in sustaining its high growth trajectory. The Indian infrastructure financing landscape is maturing, with the availability of private equity, robust regulatory frameworks, competitive debt financing, and innovative financing structures like InvITs. However, addressing challenges and maintaining government focus on stakeholder needs will be vital for unlocking India's growth potential in the coming decades. To put things in perspective on infra-financing scenario, the budget for overall capex in 2023-24 has seen a significant increase of 33% to Rs 10 lakh crore, amounting to approximately 3.3% of GDP. So far, banks have been the predominant source for infrastructure lending, with total exposure at Rs 12 lakh crore for FY23. On a sectoral basis, disbursals to the power sector constitute the highest at 50%, followed by roads and highways. If we take a look at global trends of private investment in infrastructure, then it can be opined that the global infra asset class has emerged as a resilient and effective investment avenue in the post-pandemic era. Infrastructure investments offer a robust hedge against inflation compared to other options, thanks to the inelasticity or indexation of cash flows. Various global sovereign funds, pension funds, and PE funds have made long-term investments in India's operational projects across subsectors, namely highways, transmission assets, and renewable energy. After a tepid start in 2016, the launch of InvITs 2 caught traction, and until March 2023, 20 InvITs have been registered with SEBI. With total assets under management close to about 4.2 lakh crore, InvITs have been a major driver in India's push for robust infra across the country in recent times. And with the rising push on green financing and ESG investments, renewable energy InvITs are likely to be the next sunrise investment avenue, thus boosting monetization activity for the sector. Asset classes like gas pipelines, ports, telecom towers, airports and railways, etc. may also emerge as the probable options to be taken under InvITs in the medium term. However, despite the rising preference of various investors in Indian infrastructure, certain pitfalls hinder the acceleration of its growth pace. India faces a significant infrastructure financing gap exceeding 5% of GDP. So while traditional sources such as Indian banks and government aid have been relied upon predominantly, the need for alternative financing options is evident to bridge the colossal infrastructure financing gap during construction phase. Predominantly land acquisition and approval-related delays have deterred private participation. According to the Ministry of Statistics and Program Implementation of December 22, which monitors infra projects worth Rs 150 crore and above, out of 1,454 projects, 335 reported cost overruns of Rs 4.5 lakh crore, and as many as 871 projects were delayed. Besides, lack of consistency and policy coherence across different government departments have also hindered global investors and sovereign funds from actively participating in India's infra development. Standardizing model concession agreements, bid parameters, and abolishing inefficient tax mechanisms are amongst the recent measures implemented to address investor and lender concerns. Unreliable demand forecasting studies have proved as yet another bottleneck, which have resulted in increased non-performing assets in the infrastructure sector. Therefore, in Care Ratings' opinion, the focus areas should encompass stricter enforceability of contractual agreements and legal protection to avoid litigations, deepen bond markets by pushing investors' acceptance for A category rated entities, Alternatively, mandatory adoption of EL ratings for infrastructure projects, which will expand the basket of eligible projects for monetizing and refinancing. Encourage alternative investment funds or sovereign funds to take exposure in under construction infra projects. Partial credit enhancements from multilateral funding agencies and large financial institutions can be used or introduced to facilitate this aspect. Empower the urban local bodies to come out with more frequent, sizable value capital market issuances, while simultaneously also encouraging retail participation in ULB bond issuances. Institutionalizing demand forecasting agencies may address the gaps in volume forecasts and viability studies. Adequate availability and training of skilled manpower for implementation and monitoring of infra assets can be some of the other focus areas. To conclude, thanks to the policy reforms, increased project awards by central and state authorities, and capital recycling through stake sales of completed projects, the credit profile of most infra entities in India has witnessed improvement over the past 2 years, despite the challenges posed by the pandemic. Against the backdrop of growing economy and political uncertainty worldwide, the stability and resilience of infrastructure projects provide a ray of hope for patient capital, while contributing to climate targets and the development of more robust and inclusive infrastructure. As India embarks on the Amrit Kaal era, a period of great significance, it is crucial for public and private partnerships to seize this golden opportunity by collaborating towards infrastructure-led economic growth. Thank you and take care.